The numbers were largely in line, so it probably doesn't do too much for the Fed. I think they were probably looking for a reason to start downshifting the increases from 75 to 50 to now 25, and this probably helps them lay the groundwork for those smaller increases. I think it's probably still fair to say that, they probably do have a few more of those left, those 25 basis point increases, and then they'll probably kind of sit back and see how the inflation picture evolves. There's this number that they seem to have keyed in on, which is basically core services excluding renting of shelter. That number continues to be somewhat sticky. It actually even ticked up just a little bit. And considering the fact that it's become kind of their main focus, that was maybe a little bit troubling. But again, you don't want to read too much into any one month. We think inflation ends the year actually with a 2% handle, and we think that by the end of the year that the Fed will actually be cutting interest rates, because we think there's going to be a recession kind of in the middle part of the year, that'll allow the Fed to kind of start to actually stimulate the economy into the very tail end of 2023.
Thanks very much. Thanks to everyone for your comments. I, like others, move on these approaches that we're considering and on the other topics raised today, in particular the.
So they'll probably start to increase in 25 basis point increments now as opposed to 75 or 50. The number of increases probably depends a little bit on whether inflation continues to come down. We think it will. That probably means they only have 2 or 3 rate hikes left. They'll probably stop somewhere around 5%, and then they'll probably wait until the second half of this year to see what the impacts of all the tightening over the past year has been, and then they'll probably make a decision to move forward. If we're right, that will actually be a cut, not a hike. If inflation unfortunately comes back, then they may find themselves having to raise further. But we think that it'll probably be a cut by the end of the year, because a lot of the monetary tightening in the pipeline already should slow inflation and should slow the economy into a recession that will allow them to start to actually focus on a recovery.
Happy Thanksgiving.
Right now, at least, it's still on pretty solid footing. Initial jobless claims were low once again. Continuing unemployment claims have rolled back over, and if inflation also gets under control, you could have something that's a little bit of a shade of Goldilocks that we had post financial crisis. Unfortunately, we think a lot of the tightening that's already taken place will be enough to tip the economy into a recession by the second half of this year. What we would tell investors is that, while we anticipate more volatility in the first half of 2023, we would take advantage of that. So if you're a intermediate to long-term investor and the market, let's say, pulls back and kind of gets oversold back to some of those recent lows, that's an opportunity for you as a long-term investor to start to add exposure to equities. The time to play defense has probably to a certain extent come and gone. Right now, we would kind of just be waiting for the right opportunity to start to play offense.